well. But it's all about managements, right? We have JSW Energy as well. Sharad Mahendra, who's the Joint Managing Director and CEO of JSW Energy, joins us to discuss their quarter. Thanks a lot, Mr. Mahendra, for joining in. Festive greetings to you as well. The demand in the second quarter, it looks like, there was still some untied capacity. How did merchant prices pan out, and what's your outlook for the remainder of this year?
The demand, definitely, we have seen overall basis. Quarter one, if we start with, there was a negative demand growth of almost 1.6, 1.7%. But we have seen an uptick in quarter two. When there is a quarter on quarter, in quarter two, there is a demand growth of almost 3.3%. With, of course, volume slightly reduced. On a H1 basis, there is a positive growth of 0.8% in terms of demand. We have to understand some of the factors which have resulted in this. This time it has been an extended monsoon, which has been close to five months. It started sometime towards the end of May and continued till end of September or beginning of October also. So it has been almost an extended monsoon across the country. So these are the factors which have been, but quarter two has clearly demonstrated that the fundamentals remain strong, and going forward in H2 we see further uptake in terms of the demand growth. The tariffs, what has been witnessed during this quarter, has been 3 rupees 93 paisa average, which is definitely lower, and which is purely a demand supply situation.
Well, operating profit growth actually, sir, was subdued despite higher organic growth. Explain that to us.
If you see, first we have to see the EBITDA growth, what we have seen. And EBITDA growth clearly reflects in terms of the impact of greenfield new capacity additions during this half of the year and this quarter. And also the increase in thermal generation, which has been a mix of, one is the KSK acquisition, and also the Ind-Barath Unit 2, which was available for full year, entire half year of this year. In terms of the net profit, we have to understand that lot of capitalization, one, that we have acquired KSK Mahanadi, for which we have made the entire payment. And also we have capitalized on the capacities which have got commissioned, which has resulted, if you see the total gross block, in terms of the total assets which we were having, if I go a year back, which was maybe in the range of almost maybe 60-odd thousand crores, we have added 49,000 crores of assets during this last 1 year. If we compare with September 24, taking the total asset value in excess of 113,000 crores. So all this entire 49,000 crores, which has the incremental asset, is a mix of the acquisitions and mix of capacity utilization, which has resulted in higher interest. And we have to remember that this is during the year phenomena, and these investments have not given us yet the full year annualized basis when we see the returns, which will come and stabilize in terms of going forward once this asset completes. We have paid full, but we have earned partial period only from these assets. So this is the result, which is temporary, but all the more important is with that, because of that reason, the depreciation, the interest above value has gone, resulting in a slight negative growth in net profit. But if you see, the cash profit has seen a significant growth, which is more important for us in our business, which is again supporting us in our future growths. So all these things put together, the cash profit is more important, which has shown a growth of more than 27%.
Throw some color on the new assets, the acquisitions as well, particularly KSK Mahanadi as well as Ind-Barath Unit 2. How are they panning out?
See, first and foremost, to start with KSK, it has been a wonderful acquisition. Whatever assumptions we had made before acquisition and paying the value for the asset, the first 6 months we have been able to complete, and the asset is performing excellent with availability. Significant improvement if we compare with last year H1 performance. And though we don't feel that is the real benchmark to compare with, it is our own internal plans what we had made, we compare with that, which are significantly higher than the performance asset has given last year when it was under the CIRP process. Our plant availability has been in excess of 97.5%. The PLF actual has been in excess of 76, 77%, almost 10% or more higher than what it performed last year. Lot of operational efficiencies we have brought in terms of negotiating the lot of O&M contracts and setting up the better practices, the best practices in our plant, in this plant, which has resulted in a significant reduction in operations and maintenance cost also. All these factors have definitely played out extremely well. We are confident about this asset going forward also. In terms of Ind-Barath, the second unit, yes, which we commissioned in the month of March of last fiscal, has performed extremely well. This is a open capacity in the current year. Full capacity is open in the merchant. Despite the lower tariff discovery in merchant, despite lower demand, because of the low fuel cost being at the close to the mine pit and with significantly lower fuel cost, we have been able to run this plant. Of course, the generation which has been witnessed in Q2 may be lower or the profitability may be lower. It is only because of the planned annual capital shutdown of the units, because we have commissioned just in last 6 months to 1 year, and the units have to be shutdown is to be taken to fine tune the units, keeping in mind the scenario of extended monsoon, lowered demand and tariffs. We have taken the shutdowns of both the units during this quarter, which was planned was that 1 unit in H1 and 1 unit in December, that is in H2, to take advantage of going forward in the balance 6 months period when the demand is definitely expected to be better than what we have seen in H1. So this plant also is going well in terms of what we have expected.
What about the O2 power platform, sir? How's the performance for that scaling up? And if you can quantify a few targets for us, please.
See, O2 Power, when we acquired this portfolio in the month of April, with an operating capacity of 1.34 gigawatt, out of which 270 megawatt was wind and the rest was solar. We have been able to take this platform September end, Q2 end, at an operating capacity in excess of 1.8 gigawatt. These are the greenfield commissioning which we have done post-acquisition. This is one platform. Of course, we have to remember that this is a solar-dominated portfolio, whatever is operating. And we have seen the extended monsoons when the radiation levels have been comparatively low at country level. The solar PLFs have been same or slightly lower than what it was seen last year. And this is a normal phenomenon normally in the case of solar when H2 is better than H1. But this time, because of the extended monsoon, it was slightly even lower than what was expected. So we expect going forward that the performance of O2 platform will be better than what it has been seen in H1. And we are sure that the capacity by year end, we will be reaching somewhere in the range of 2.2 to 3.3 gigawatt of solar of O2 portfolio. So it means almost close to a gigawatt of fresh capacity will be adding post-acquisition in the current year only.
Take that point entirely. Thank you so much for joining in and giving us an outlook. We wish you once again and your team a very happy festive season. With that,